So before we get into what is happening on the U.S. debt side and some of the other pressures that we've been talking about, we just wanted to highlight the Treasury 20-year bond yield. So the auction came in at 1.92%. And when you think about the high yield was at 1.92% versus 1.657% last auction. So you're, again, increasing capacity or increasing interest rates because you're trying to get people to actually purchase this debt, and the bid to cover came in at 2.15 versus last auction of 2.28. So less bidders, higher interest rate. Again, this is what we keep talking about when we're looking at what is happening at the yield level, and these yields continue to go up, which is something that we're looking at. The 10-year Treasury constant maturity minus 2-year Treasury constant maturity. You can see that we're looking at an upward trajectory, and this is where the last time we've seen these moves, and that's just given where we sit, this is something that we think is going to continue to move up over the next few months. Now, where are the major holders of U.S. debt? So the Federal Reserve is obviously the biggest right now at 4.6. Japan is at 1.3. China's still at about 1. So, and these are in trillions, just to clarify. So the Federal Reserve is taking a lot of this volume out, and as the U.S. government issues more debt to cover their deficit, the Federal Reserve is going to be limited to how much they can continue to buy, which is going to push more of this debt into the market. And essentially the market's saying, you're going to have to give me a higher yield because there's less people showing up to purchase this debt, and because obviously inflation becomes a bigger issue. Now, when we look at other holders, Federal Reserve, and again, foreign holders, you can see that foreign holders are still at $7 trillion. Federal Reserve is at that 4 point. Obviously, the one on the left is November, one on the right is September. So Federal Reserve is actually higher. But when we aggregate it all together, you can see that the foreign holders still remain a large portion. But as foreign countries are purchasing their own debt, as more debt keeps coming in, this is where we continue to see these issues arising when we're looking at what is the activity in general on the debt side of the equation, which makes it onerous, and which is why we keep talking about the high yield, the bid to cover ratios across the curve. And China's holding of U.S. government debt, just looking at it a little differently, they've started to sell this debt in order to pull forward some of these dollars to help secure what is happening at their balance sheet level, because they're short collateral and they need those dollars pulled forward to help solidify balance sheets, as well as what they're trying to do because they continue to push additional debt into the market, which is something that we're going to talk about in the last segment. Then when we look at copper demand versus copper supply, because we want to talk about inflation is happening for a lot of reasons. It's also a supply constraint. So when we look at the global refined copper usage, obviously when we talk about, in the first segment, we looked at the grid, the expansion of the grid. We have renewables, we have EVs. They all require a lot of copper, and then we need to upgrade our infrastructure, which again is going to demand additional copper usage. So the demand continues to grow, and we're just not increasing total supply, which is pushing a lot of these prices higher, which is the issue when even if we were to get the dollar going higher, we were getting rates going up. And, obviously there's a certain amount of inflation priced in, but there's also going to be that demand level that is going to make some of these price increases sticky across some of the commodities, specifically not only just food, but also a lot of these, commodities that we take for granted going into electrical equipment. And while all of this is happening, obviously U.S. home price appreciation is continuing to move up. The dense has moved up less, obviously because people are moving out of urban versus less dense urban and suburban. So less dense urban and suburban have been moving up in lockstep, which is why I keep saying the CPI on rent is wrong. Because when you take those two together of less dense urban and suburban, price appreciation is up. And this is always going to reflect as well into those single family home rent. That is going up as well, which is why we keep talking about this price appreciation that needs to be reflected or at least understood on the CPI level. Then when we look at state and local orders bringing down evictions, how much are evictions actually being reduced? And it's different depending on the location based on the CDC order. So New York, Arizona, you're seeing the differences in terms of what is happening. Connecticut, Texas, Minnesota, they haven't been able to do as much, but you're still getting an increase in general. Like, it's not going to zero. You're still getting some of them. It's just not at the level that it should be or that it was in previous years when you look at where it was in January of 2020 versus where it is in January of 2021. So clearly there has been a halt. It's just, depending on the level of that halt, it is going to vary. When we look at Austin, Texas, you can see Boston, you kind of get an idea of where things are. But as this starts to normalize in general, as the normalization continues to roll through the system, that's when you're going to see additional capacity on the retail, on the real estate side coming available, because even just on normal activity levels, we're still down, and we have an increase in delinquency. We have an increase in back rent, totaling, I think it's now $5,600 on average in back rent is owed. So when you start to see those people getting evicted, foreclosures on mortgages, that's going to put things above where we started in January of 2020, again, which is why we keep talking about how much supply is going to come back to the market. It's not going to be a huge shock because there is activity happening. It's just there will be a big bump above last year's activity. And that's why when we look at, I can't beat this to death enough, but when we look at average U.S. consumer price inflation, here's your normal kind of steady move down, and this is why we think that we're getting that reversal higher, as you can see, versus, again, asking rents and effective rents. Now, the asking rent has gone up, again, CPI level, but effective rent has gone down because people haven't paid rent. Again, there's bifurcation in the market, which will have to close at some point to see people and essentially get some sort of normalcy back into the market on a rent side. Now, when we look at margin debt, how much margin is in the world? Well, if we look at it as a percentage of the Wilshire 5,000 market cap, which, as we know, the market caps have exploded, you can see that it's actually fairly low versus the FINRA margin debt as a percentage of GDP is at all-time highs. So because people are leveraging themselves against, something as stable as the Wilshire 5,000 market cap, I think it's better to look at it as a percentage of GDP, just to put into context on how large some of this is. Because even though market caps have gone up and it's not a huge number, GDP hasn't. So GDP is going to be a reflection more about the real economy versus the, let's call it, I don't want to call it the fake economy, but versus market cap, which can get inflated due to margin. So again, I think the blue line is better than the orange line. That can be debated, but just an idea. So you can see that they've both gone up. It's just margin debt as a percentage of GDP has exploded. So then, this is looking at rents again, medium asking rent versus CPI primary rent. I don't know if I have to explain which way that's going to go because I think it's self-explanatory. And here, when we look at, and for those that are listening on podcast, one is way higher than the other, which just means that the medium asking rent is at about, the left side is about 20%, and the CPI primary rent is at 2.5%. So you can figure out where that's going, where it should be closer to about 6%, which is, again, CPI rent increase. Employees at home-based client firms changed from January 2020. As we go into Feb, we're still below that pre-holiday hours in terms of the employees at home-based client firms. Again, speaking to the headwinds that we continue to see in the employment world as hours worked remain low and people just aren't getting back to work in the same way, which is going to be a problem. As how much can they spend after they've gone through their the amount of debt, or I should say the amount of stimulus that they receive from the government, which is why we think it's more of a shot in the arm, replace savings, and then we're still not seeing that turnaround in employee hours. And now when we look at the foreign financial commercial paper outstanding, this comes to why we're not seeing as many people take part in our U.S. auctions, because there's more and more commercial paper outstanding in the financial world, which is something where when we look at what are banks doing to try to make those rates on the overnight side, they're going out and purchasing more of this commercial paper, which again, taking advantage of the bubble. As you can see, the run up in '08, then the collapse. We continue to see guys taking advantage. We saw that from 16 and to 17. This is going to be one to watch as to when does this start to fall and roll over. And that's where when we start talking about, some of these bifurcating components of steeper job losses in lower wage workers. And this is why we keep talking so much about, we have to break things down by income, because the lower middle wage is having that downward pressure. Upper middle wage is starting to see some of that bounce, and higher wage is, the job losses have gotten to a little bit of a growth side, but the pressure is going to remain at the lower end, where that's why we start talking about how much fiscal stimulus will actually make it into the market versus recovering savings. And this continues to be a bigger issue on differences. Then when we look at what has happened in general, this is at January 23rd. You can see that total unemployment benefits is at 20.5 million, continuing to grow over time. It'll start to come down as we get into January, because this is kind of a makeup number given some of the states that were delayed in general from 1 month from the holiday season. So we had a little bit of that backstop, but there's still a lot of people on unemployment benefits. And that's why when we look at people that feel pessimistic, just to reiterate this slide, people just don't feel confident in the market, because and that's where we're seeing them longer and longer on that pandemic unemployment, which you can see here, where more people are going on to the extended benefits, the pandemic emergency unemployment compensation, pandemic unemployment assistance. Regular benefits are going by the wayside, and they're getting put onto the extended benefits, which again is causing that certain amount of depression that is showing up in consumer confidence, and, where they think things are going to be, and can they get a job. And that's all happening as we have a growing trade deficit, where guys are trying to pull in more capacity to make do with that surge in that retail side. So that's why we need to look at what is happening when we look at wholesale inventories, where inventories, this is going to start to mitigate as we come into January, but this is also going to increase or cause problems when we look at prices paid, prices received, what are the supply chain issues. And this is also a big component of where we are in the world today, as less stuff is made in the US. So that, again, less jobs, less manufacturing, less activity to come back to normal, which is that weight overall in general. And that's where when we look at the manufacturing jobs that have gone abroad, how much can we get back to normal? And this is the permanent unemployed is worse than the last two recessions, which is going to be something to watch, as how quickly can we get back to normal? Because the employment data, while better, is still a bigger overhang. When we look at, can people get into other areas, other industries, other activities, or are they going to have to take a lower wage because the company itself is also taking more risk? And then when we look at the MBA purchase index, the mortgage-backed, when we look at mortgages in general, boom, it's just up and out. So this is something where when we look at 2021, this is going to continue to move up on that purchase index, and we're going to continue to outpace even the most lofty years. And that's when we look back to, and again, always trying it to tie it back to inflation, CPI commodities, X food and energy, CPI services, X energy. Again, we're seeing that services starting to reverse, but services is going to be different than the commodities in general, as we've started to see the commodities flatline, but now food and energy are taking off, which is going to pull some of that higher in general, making that CPI number pull up overall. So then the share of employees person who can telework, And this is just looking at the amount of people that are working from home, just to give a concept of what is, even though things have gotten better, we've had some reopening of the states, and this is something that we're going to cover in the EIA show, the dynamics of weekend and weekday activity still remain very stark, as weekday activity remains under pressure given the amount of people still working from home. But even while all this is happening, when we talk about what should be the minimum wage, what is happening in general, you can see the U.S. minimum wage is flatlined as U.S. corporate profits have reached new or recent all-time highs. And this is going to come back to how much of the minimum wage has to come up because you're getting less share of corporate profits. But then the minimum wage issue gets a bit more complicated because a lot of union contracts have to be a percentage above minimum wage. So then union contracts will restrike higher, and smaller companies and small businesses won't be able to make up the corporate profits that you see here to the same level. Again, it's going to be that big box versus the small guy. And how do you have that operationally work? Where is there a level, if you have over X amount of employees, you have to pay this minimum wage. If you have this many employees, you have to pay this minimum wage? Does that create an issue where then some of the larger companies will shrink workforces to get below that, laying off people but then would they have normally laid them off if their costs were going up? I mean, I could do a whole segment on just minimum wage, which I probably will, but these are just some things to consider when we're looking at the future in general and where the minimum wage argument shakes out, because it's also not the same across the U.S. Like obviously New York has a higher cost of living, so New York is already paying wages closer to 15, where Mississippi doesn't. And again, should it also be struck based on the weighted average of cost of living versus just a fixed number? And again, seeing the complexity, because maybe it makes sense then to headquarter in Mississippi instead of, let's say, just based on Missouri, based on some of the differences on, the $10 in Mississippi versus $12.50 in Tennessee or Missouri. You're starting to see how this can get complex, but maybe it makes sense to have that weighted average in general of where things should be on that 25th percentile. But the wage share in the U.S. economy has been declining, will continue to decline as we continue to discuss wage compression over the last few years, which is just getting worse in general. And but just to highlight again what we're talking about. So the 10-year average percent of nominal GDP has essentially done really nothing. It hasn't seen all that much growth once we back out inflation, especially inflation in government spending. And the U.S. compensation of employees is still such a wide dynamic that is just weighing on where do wages go from here. And this leads to that social immobility, that inequality aspect that we keep talking about, which is driving a lot of these issues between the two nations, as we keep talking about high wages, low wages, breaking it into 3 quartiles, 5 quartiles. It continues to come back that lower. In 5 quartiles, the lower third. In 3 quartiles, the lower 2 continue to be under pressure. And this is, again, creating that inequality, which we keep talking about. Now, in the next segment, we're going to roll into Europe and kind of show that some of these issues that we talked about in the U.S. are still cropping up and becoming a bigger issue as well in Europe and Asia in general.